evening, Amit, to the call today. Today's call is organized by PMS AIF World. We are a new age investment services company, and we do two things very well. One of them is wealth management. The other is content, information, and analytics, as a part of which we all are here gathered today. So we have been in business for 2 years, and in the short span of time, we have managed close to 400 crores of assets in AUM, and we have a lot of NRI families and Indian families as well. And we typically follow 4 P's in a portfolio before we recommend them to our clients. One of them being the obvious performance, the other 3 P's being portfolio, price, and philosophy. And as an important part of informed investments, we today have gathered to know more about a very interesting portfolio called Stallion Asset. Amit Jeswani, the co-founder and CIO of Stallion Asset, is with us here today to discuss more about his portfolio. Over to you, Amit. Let's not keep the participants waiting. Thank you for being with us today.
Thank you, Sankalp. Thank you so much for having me here. It feels good to be in suits again. It's been 60 days. We've been locked down home. I hope the next 60 days are a lot better than what the last 60 days were for the markets and for me personally and everyone who's been locked down home. Sankalp, we'll just move on to the slides. I'm going to give you a small presentation. It's not going to be small. Once I start speaking, it typically goes on for a larger period of time. So that is us, Stallion Asset. Sankalp, can we go to the next disclaimer page? As you know, we're a SEBI-registered portfolio management company. We're also a SEBI-registered research analyst in the country. So a little about us. Sankalp, we go to the next one. About us, I am the founder of Stallion Asset. I'm a CFA and a CMT. I graduated from Kingston University, London. Well, for the ones who are watching the image on the right-hand side, that was our entire office in 2014. That was not us. That's not my cabin. That was the entire office. So that's how small we started, and we've come to become. There were about 2,500 portfolio management companies in the country. 2,500 research analysts and advisory companies in the country. We're probably the only one who become a PMS company, and this happened because we created value for our clients. So we didn't come here by a parachute. It's been a long journey of helping our clients create wealth. I'm Sindhi, and we spent less than 1% of our revenues on marketing. So it's clearly word of mouth that worked for us. So that's a very small breakup about us. We got our PMS license in 2018 end. November 2018 is when we started the PMS. Before that, we were a research analyst company. Next slide. Sankalp, can you zoom the PPT? Can you make it like full screen or something?
Let me just.
Yeah, this one on the, you can see that alcohol glass kind of thing, like a glass. You'll have to, can I do this?
I think this is the maximum if I can zoom.
Okay, no worries. So what have we done after launching our PMS? 3 fees, very important. We were up 29.62% in 2019. That was against minus 4.32% for the CNX mid cap. I'll just repeat again, this is pre-fees returns. This is not post-fee returns. In the current calendar year, that is the first 5 months till 15th May 2020. That's 5 months broadly. Our portfolio is down 10.47% against 24.03% for the benchmark. So it's been a decent start for us on the PMS platform. Next slide. I'll probably move to the next slide. Yeah. So the macro outlook. This is the first side of the presentation. Fed started. This is an important slide. Fed started in 1912. about 108 years back. From 1912 till 2008, Fed printed $900 billion. After 2008, Fed started printing more money. And from 2008 to 2019, we went from 900 billion to $3.7 trillion. In the last 6 months, we've gone from 3.7 trillion, that is the printing money I'm speaking about, to 6.9 trillion. More money has been printed in the last 6 months than that was printed in the last 108 years. When you print so much money, so the game is simple. The only way to come out of a bubble is to create even larger bubbles. And that's what the Fed is doing. There is going to be massive money supply in markets broadly, and that will create larger bubbles. So if you see the last, next slide, Sankar, if we see what happened in the last decade, we saw Greece bond yields go from, the yields of Greece were at 42%. Now they're at 2%. We saw Greece, Portugal yields at 17%. So there was a massive bond bubble because of excess printing of capital, of money. ECB was printing, the Japanese government was printing. When you print so much money there, it creates a bubble. And the last decade, we saw a massive bond bubble where more than 20–30% of bonds are now yielding negative. So that's the amount of liquidity that's been pushed in the system. The second chart on the right-hand side is the chart of NASDAQ. If you see how NASDAQ performs, NASDAQ went up somewhere around 5x in the last 5 years, in the last 1 decade. It tells you what printing of money can do. And now, as I told you before, in last 6 months, Fed has printed more money than that was printed in last 108 years. So we are going to see a bubble going forward. The only question, so we'll go ahead. Pankaj, what's the next slide?
Sure.
So the last bubble, the last 10 years were what happened last 10 years? The last 10 years, growth stocks performed better than value stocks. And this was a report by Goldman Sachs, and only 15% of MSCI World, basically the index for the world stocks, only 15% of MSCI World stocks grow at more than 8% now. This number 2 decades back was 45%. So growth is scarce, and markets are going to reward growth massively. You can look on the left-hand side. If you see the chart, it's about how growth stocks have done versus value stocks. And you can see when you divide growth stocks by value stocks, it is absolutely similar to the 10-year bond yield of Germany. So it's basically till the time your bond yield remain at these low levels, growth stocks will absolutely outperform value stocks. Sankar, we go to the next slide.
Just a second. So the next slide is loading.
The point I'm trying to make is that there is a bubble coming. And the question is, where is that bubble going to be? Is it going to be in gold? Now, if US prints so much money, the money will have to go to some asset class. Can the dollar, now, if you print money, we were taught in school that the dollar will depreciate against, if you print money, your currency will depreciate. Clearly, that doesn't work. It doesn't happen. The thing is that US is printing, Germany, the European Union is printing more, and the yen, the Japanese government is printing more. So in this case, the dollar cannot get depreciated against the US, against Europe or yen. But if you keep printing money, it has to get depreciated against some asset class. There's a good probability that asset class is gold. If we see the last 16 recessions, global recessions, The only asset class that performs well in 3 years after the recession is gold. So there's a good possibility that gold can do well. The second thing is NASDAQ 100. These are growth stocks, and they were the leaders of the previous bull market. But technology is now utility. It's just like electricity. We've not stopped using Facebook, Instagram, WhatsApp. We are seeing movies. It's all technology. So can that lead? Where will that money go? The big bubble money is there. Can that be NASDAQ? The third thing is developed bonds, developed market bonds. We've seen last 10 years, we've seen a large bubble in developed market bonds, and they've started yielding negative. A large percentage of developed market bonds are yielding negative. So the upside in developed market bonds is now limited. It's unlikely that you're going to make a lot of money buying developed market bonds. The fourth asset class is emerging markets. Emerging markets have done nothing. But typically, if you see the history of emerging markets for the last 50 years, the only time emerging market does better than developed world is when there is very high global growth. And in these times of deglobalization, we do not expect emerging markets to do well. The fifth one is crypto. Digital is digital currency. When central banks keep printing money, the trust on central banks decreases. So there's a very good chance that money starts going towards alternative currencies like Ethereum, Bitcoin, Binance. So a lot of crypto. So money has to go someplace, and money will find where fundamentals are right. And that's the whole thing. So big money is there. There is going to be a bubble coming. The only question is, are we going to ride it or not? We move to the next slide, Sankar. So the Stallion way, this is the more important part. This was the last 5-7 slides was just about the macro outlook, what we believe. We believe there's a bubble coming. We're not very confident on what asset classes yet, but there is 100%, we're 100% sure a bubble is coming. Stallion way of investing. So these are principles that we have developed over time. Principles are smart ways of handling situations that repeat again and again. I didn't start with principles, and believe me, to acquire these principles, we've made a lot of mistakes, and by doing mistakes, we learned and made ourselves better. We look out for patterns of the most successful companies and companies that fail, and then find commonalities. What was common in the most better performing companies, and what was common in the worst performing companies. The most valuable things what I've learned in life are from my mistakes. We reflect upon it. We see how we can do it better. I'm going to speak about 15 rules of my 15 years of stock market. So these, Sankar, we move to the next slide. These are the 15 rules. For stock picking, we use, it's an important slide. These are our 4 M's. For every Stallion stock, these 4 M's have to be in place. The first thing is market opportunity. How large is the addressable market the company can take on? Second thing, market leadership. That's our second M. The third thing is management, the quality of management, capability of management, and we will go into every principle in detail. We're just giving you a broad outlook. The fourth one is margin of safety. That is broadly the valuation part. Believe me, the way Stallion values company is very different. We do not even see at P ratios so much. So there are only 4 kinds of businesses, and in 4 times, different times. A good business in a good time. For example, let's say Muthoot Finance right now. Gold prices are going higher. Unsecured lending has stopped. So unsecured lending had stopped in 2008 as well. When 2008 crisis happened, unsecured lending had stopped. That time, in between 2008 and 2010, Muthoot Finance increased his AUM from 20,000 million to 70,000 million. So there's a 100% basically a CAGR growth for 2 years. So I'm just giving you an example. Okay, very important thing. I'm going to give you examples. We might have vested interest. We might own them. We might not own them. We can sell our stock. This is very important. Please do not replicate these kind of like what stocks I speak about. We are very fast sellers as well. and we will not inform you if we sell out from our position. So Mudhoot Finance is coming back. Mudhoot Finance is an example of a good business which generates 30% ROE in a very good time for them. The competition is now out of the game. The second kind of business is a good business in a bad time. Something like Bajaj Finance, it's a monopoly in consumer lending in India. There is no number two of consumer lending in India. They have basically the best systems, best technology, and it's like a fintech company into lending. But they're going through a bad time, of course, because of reasons, a credit crisis. We are looking at a credit crisis. There are going to be defaults. So it's a great business model. Consumer finance, if you look at, let's say, American Express, or a lot of credit card consumer finance companies, they've been massive wealth creators around the globe. So I don't see why Bajaj Finance won't do well in the long term. But of course, it has short-term challenges. And tomorrow is the numbers. Let's see what happens there. A bad business in a good time. This is the third kind of businesses. This is where we all lose the highest money. When you buy a bad business in a good time, it's basically, I was buying wholesale NBFCs from 2014 to 2018. So you make, basically these companies will start growing pretty fast, but nobody ever has made money in India in the last 20, 25 years in wholesale financing. So it was a bad business model. The cycle was good. We made money, but for the ones who could not exit, you lose a lot of money there. A bad business and bad time, no one actually buys these kind of businesses. So these are the four things that we look out for: market opportunity, market leadership, management, and margin of safety. I'm going to keep giving you examples of stocks so you can relate to them. Sankalp, we move to the next slide.
Just a second.
Yeah. Market opportunity. Now, there are only four kinds of businesses. A shark in an ocean. These are market leaders with large opportunity size ahead of them. Let's take an example of DMart. DMart has 200 stores currently. And globally in grocery retail, the one with the lowest cost always wins. Be it Costco in US, Walmart in US, Tesco in UK, Carrefour in Europe. The one with the lowest cost always wins. DMart's operating cost as a percentage of sales is 7.5%, whereas for Reliance Retail, it's 24%. For Future Retail, it's 26%. DMart is very efficient and it's the lowest cost guy in grocery retail. So the number of stores of Tesco in the UK is 3,700. The population of UK is 6 crores. The number of stores of Walmart in the USA is 4,200, and the population of USA is 32 crore people. So DMart is at 200. There's a large opportunity ahead. It's the market leader, and customers love the product. The second thing is a shark in a pond. These are businesses which are market leaders, but the opportunity size isn't that large. Probably a Reliance in the refinery business. So you are the market leader, but the opportunity for you to grow isn't that large. The third kind of businesses are a fish in an ocean. This is like in financials, I would say probably an AU small finance bank. It's small, it's growing. We don't own it, but it's small. But it's like a fish. If you make money in the fishes in the ocean, you make it very large. But mostly fishes are acquired or killed by sharks. The fourth kind of business, which is the worst business model ever, that's a fish in a pond. The opportunity size is small, and the company is also small. So those are the four kinds of businesses. When we look at our stock, we typically want to be, and large percentage of our portfolio are allocated to sharks in an ocean. The size of opportunity is the foundation on which large wealth creation lies. Simply put, it's the size and duration of growth of a business. The only way to make money and sustain your money, retain your money, is to bet on sharks in an ocean. That's basically a consistent compounder kind of portfolio. The next slide. Market leadership. That's our third principle. This is the third thing that we look out for companies that we invest in. There is absolutely nothing which is worse than competition. Monopoly is the only condition for every successful business. Every business starts by solving a problem. Every business becomes large and succeeds if it is the only one who can consistently solve that problem. 60 to 80% market of the profit pools in all industries are with market leaders. When you look at car industry, 70-80% is with Maruti. When you look at paint, 70% is with Asian Paints. Jockey is more than 50%. Apple sells 13% cell phones in the world, but it is 85% of global market pool. All other players like Samsung, Lenovo, Oppo, Vivo, they are all on Android and they compete over each other with price. Apple is a monopoly. It's differentiated. It's unbeatable in that game. So all you need is happy customers. Happy customers equals to happy shareholders. I'll just see the time so we don't exceed. Okay. Entrepreneur's dilemma. We speak to a lot of entrepreneurs. Entrepreneurs, आप जब भी कोई entrepreneur से बात करोगे ना, all entrepreneurs will say that Amit, I am in a 10,000 crore industry and I want to be 1% of that industry. That 1% of industry in a 10,000 crore industry is 100 crores of revenues. And I will make, when you speak to entrepreneurs, 10,000 crores की industry में 1% is 100 crores. And I will be rich. But believe me, this doesn't work. This is not how business works. Business is about creating monopoly, sustainable consumer monopoly. And I tell them, and I always tell them, I don't create a 100 crore business in a 10,000 crore market. You will be a fish in an ocean. Create a 100 crore revenue business in a 200 crore market. Own the market. Be a monopoly. Monopoly is the only way to create long-term sustainable wealth. So that's our principle number 3. We look at companies which are differentiated and are creating monopolies. Sankal, we go to the next one, principle 4. Management. This is a very important topic. There are only 2 key roles of a management. Number 1, capital allocation. Number 2, capital distribution. So when we judge a management on the capability of a management side, we look at 3 things, the 3 S's of a business: speed, scale, sustainability. Scale क्या speed से कर सकता है, क्या कितना बड़ा हो सकता है, और sustainable कितना है. Because if you grow too fast, but you can't sustain, it's not going to be worth it. So we will discuss more about capital allocation in the next slide. But what we typically look out for in capital allocation is, let's take an example of Relaxo Footwear. This is just for example purposes. Relaxo Footwear has invested 90 crore rupees in a new plant. On that new plant, Relaxo makes 1 lakh shoes daily. That means in a year, Relaxo will make 3 crore 65 lakh shoes. He invested 90 crores. Relaxo sells shoes at broadly the average ticket size of Relaxo selling shoe is 130 rupees. That's the average selling price for Relaxo to sell a shoe. Relaxo makes 9 rupees profit on a shoe. If you sell, let's say 3.64 crore shoes and you make 9 rupees profit per shoe, you will broadly make a 30 crore profit in a year. He invested, the owner of Relaxo invested 90 crores. That means the ROIC of a business, of this business, is 35%. That's how we calculate ROIC. The most important role of a management is, so there are 2 kinds of businesses. One is a HDFC AMC kind of business, which is an asset-light business. In these kind of businesses, you don't need capital to grow. This is the asset-light business. इसमें कोई capital की जरूरत नहीं रहती है. You just keep growing. It's like a services kind of business. And here the most important thing is capital distribution, like CDSL, NSC. You don't need capital to grow. So here the most important thing is capital distribution. For businesses like, let's say, D-Mart or Relaxo Footwear, they can consistently get free cash flows and can reinvest for us at 30-35% ROIC for a long time. So that's where the capital allocation comes into play. We will speak more about it, but that's how we judge management. Hoarding of cash decreases value, especially for companies who are asset-light compounders, and markets will punish them. The last line for management, and this is something you learn over time. I have learned the hard way. Integrity. A bad person is a bad person, and he will never make a good deal for you. The world is filled with good people to do business with. A fair value of promoter with no integrity is zero. Sankal, we move to the next slide.
Sure.
We do not try to invest in companies which have dodgy management. Margin of safety, valuations. Now, this is where we get a lot of questions. So let me tell you how we look at valuation. A value of a firm is a steady state value plus future value creation. How do we come to know about future value? Steady state value is very easy. It's just your free cash flows today divided by cost of capital. What is the value of a firm? The value of a firm is reinvested capital. Kitna paisa aata hai? Reinvestment, how much can he reinvest? So basically reinvested capital into ROIC. At what rate is he reinvesting minus cost of capital into competitive advantage period. What divide by cost of capital is not so complex. What this means is how much capital is he getting and at what ROICs can he reinvest and for how long time. I was speaking about Relaxo. We'll just continue on the same example. I could have given you many more examples, but Relaxo, the India's total shoe market is 220 crore shoes. Relaxo makes 18 crore shoes. So Relaxo is 6% of India's shoe market. Relaxo 130 रुपए में बेचता है और सलमान खान को प्रमोट एडवर्टाइजमेंट कराता है, आलिया भट्ट से कराता है, सिद्धार्थ एक्टर से कराता है. So basically, how does this guy has a production advantage because he is the lowest cost producer and unorganized guys cannot fight him. And he is also a branded guy. So when you're buying a 130, 150 rupee shoe, 200 rupee shoe, you would prefer a Flight or a Schoolmate or Hawaiian or Sparks. Sparks is just like Nike. It's like the Indian version of Nike. Over the more like basically because it's branded. So basically Relaxo generates operating cash flow, can consistently reinvest at 35% ROICs. For a very, very long time, and there will be no competition who can beat him so easily. So that is how we value companies. The second thing is market cap to opportunity size. This typically works for sharks in an ocean. So something like Godrej Properties, India. So the total number of real estate builders in the top 5 cities were 10,000. Now, I don't believe how there will be more than 4, 5, 6 builders in every city surviving after Corona, Grera, and so many things. Godrej this last year sold 5,600 crores of property in 1 year. 5,600 crores. Now Godrej borrows at 7.5%. All other real estate builders borrow at 20, 24, 30, 40%. Godrej doesn't buy his own land. He does JV. Godrej Properties I'm thinking about. He does JV where land किसी और का होता है और ये सिर्फ फोटो दिखा के बेचता है. 70 to 80% of Godrej's inventory is cleared within 1 week of launch because people believe in the brand. And he doesn't even make the building. He gives it on contracts to companies like Capacite, L&T, Shapunji, Palunji. So think about it. This guy didn't buy land. This guy borrows at 7.5%. This guy didn't construct. ये सिर्फ फोटो दिखा के आपका 4 साल आगे का जो प्रोजेक्ट डिलीवर करने वाला है वो आज ही पैसा लेता है. So that's the kind of business. So you bet, and Godrej is $1.5-2 billion of market cap. Godrej Property. So you look at the opportunity size, the total real estate in Mumbai, Pune, Bangalore, Chennai, Delhi. The real estate sold last year were 4 lakh crores. Now this guy is 5,500 crores out of that 4 lakh crore market. Can we scale it up? So it's market cap to opportunity size. That's the second way we look at margin of safety. The third thing, this is a very interesting thing, it works for financials. Price, and this is different. Price follows fundamentals. Typically, when you speak to Warren Buffett, see all these videos, they always say that look at fundamentals and the price will go there. Like the markets will go to the real fundamental value. But in financials, fundamentals follow price. So, first of all, we strongly believe value investing will never work. People are buying low price to book financials for last 2.5, 2-3 decades. They are buying same SBI, Dena Bank, Bank of Maharashtra. Bhai, nahi chalta hai value investing. Not in financials. In financials, you want companies who can raise capital, dilute your equity capital at high price to book. If you can do that, you basically, raw material is capital. And if you can do that, you can keep growing faster. So if a company, let's say Bajaj Finance used to dilute capital, so it was growing at 40%. People used to love it. People used to give more capital. When you give more capital to Bajaj Finance, he can grow faster at 40%. And he would consistently dilute his equity at higher prices. Financials are trending. If now the stock price goes higher, it becomes now impossible for Bajaj Finance to raise capital. Because now Bajaj Finance knows that he will not get capital. And if he gets capital, he will get at very bad valuation. So he will automatically slow down his growth. So broadly, what I'm trying to say, in financial fundamentals follow price. Where goes the price? There goes fundamentals. Price to book, PE ratio and PB, and we have a very strong conviction on this. Price, PE ratio and price to book, with most people see, they work only when your growth rate is less than your cost of capital. It's mostly crap. It doesn't work well, but so it works only for mature companies. The kind of companies we buy have a growth rate of more than 10%. So you cannot value. Theoretically, we were taught in school that value of a stock equals to free cash flow into 1 plus G divided by cost of equity minus growth. But if your growth rate is higher than your cost of capital, you cannot value a company. Basically, we try to buy companies where growth is so high that there's no possible way for any Excel to fairly value that company. Madness of the crowd is overrated. Wisdom of the crowd is underrated. People think that we believe in the wisdom of crowd. If the market tells us you're wrong and the markets are right, we believe, yes, we're wrong and markets are right. That's a margin of safety for us. We have strong feelings and understanding and comments on deep value investing. Deep value investing, we don't do it. Deep value investing works only in 3 places. That is textbook, Twitter, and WhatsApp. You cannot make money doing deep value investing. There is no evidence for last 10, 20, 30 years. Uncle, we move to the next slide.
Sure.
I'll now hurry up so that we can.
Yeah, we want to take a few questions also, Amit.
Okay, sure. So there are only 4 sectors we typically invest in. So I'll just do it a little faster. There are only 4 sectors that we invest in, like large percentage of our portfolio. That's consumer, financials, consumer pharma, consumer technology. These are sectors that get better with size. Most companies like steel, aviation, commodity, infrastructure, they get worse with size. So if a sector gets worse with size, let's take an example. If you are a Dilip Bilkon, okay? Dilip Bilkon is India's largest road construction company. But when Dilip Bilkon becomes very big, let's say it becomes 10-15% of India's highway order book, it becomes difficult for him to grow, because agar ek saal order nahi aaya, so pura game, matlab, you still have to, because you've created such a large infrastructure, now you cannot stop. So you don't want to be in businesses like steel. Someone who has a 5 million steel capacity or someone who has a 25 million ton steel capacity, there is zero difference in pricing. You are not getting better with size. Economies to scale. This is something that we look out for. This is very important. Hear this out very carefully. Economies of scale. In certain companies, as the companies get better, they earn higher margins and higher return on capital, because the product becomes more valuable with each new customer. In most industries, competition forces returns back to reasonable levels. But in increasing market returns, competition is kept at bay and decreasing unit cost of market leader. I'll just give you an example. MCX is 90% market share of commodities. NSE does 20 crores of turnover daily. BSE does 5 or 6 crores of turnover daily. India's total commodity market turnover this year will be somewhere around 40,000 crore rupees daily average traded volume. If this goes from 4 lakh crore, from 40,000 crores daily traded volume for commodities to, let's say, 5 lakh crores in the next 10 years, MCX को कोई cost नहीं आ रहा है नया. So your ROCs will keep increasing without a new cost. That is increasing returns to scale, and the competitive advantage keeps getting better, and there will be no one who will be able to compete MCX in that kind of business. So we going short, we invest only in four sectors: consumer, technology, pharma, and financials. We move to the next time. Same like HDFC. HDFC Bank gets better with size. Sustainable growth. High growth companies offer shareholder returns 5 times higher than medium growth companies. Growth predicts long-term success. That's what McKinsey says. Growth is the single most important thing. A good quality management, ROICs, everything else is useless if you can't grow fast. And you can't grow faster than the market. But remember, sustainability of growth is a lot more important for value creation and wealth creation. If growth is very patchy, you will not make money. Only very special companies can grow for a very long period of time. And they need to have some advantages. Number one, consumer advantage, a strong brand name like HUL or Nestle or Coca-Cola, Pepsi, network effects like Facebook, Android. You are on Facebook or WhatsApp because your friends are on WhatsApp. Even if, let's say, WeChat comes with something better for you, you are not going to shift from WhatsApp to any other platform, right? These are strong network effects. You need network effects for your growth to sustain, or else capitalism will kill your growth. Production advantage. Let's take an example of Varun Beverages. Varun Beverages makes 1,200 crore bottles of Pepsi and Tropicana every year. And if you divide it by 365, that's broadly 3 crore bottles every day. So Varun Beverages is 85% of Pepsi's business in India, which is Tropicana and Pepsi, the drink we heat. He has a massive production advantage, making 3 crore bottles. If you just divide it by 24 hours, 3 crore divided by 24, okay, you can do the math. I think it's 10, 12 lakh, 15 lakh bottles in an hour. So you know how large a production advantage is there. There is no way Pepsi can change Varun Beverages as his India distributor for next 10, 20, 50 years. And that's a competitive advantage for Varun Beverages. The third one is government advantage. We do have one stock which has a government advantage, but let's not speak about that. In capitalism, the only thing I can guarantee you is that as soon as one person starts making money, competition pops up, and they will try to kill you by coming on by new services, new prices like discounting, promotion, advertisement, and that's how capitalism works. So you need these advantages for growth to sustain. Sankar, we go to the next slide.
Sure.
Winners of the last decade. What won, what lost? Nifty EPS on 1st of January 2010 was 225 rupees. Today, it's about 450 rupees. So Nifty has grown only at 7% CAGR for the last 10 years. Only 7% CAGR. The Nifty 50, the index, the Nifty was at 6,100. Today it's at 9,100. Broadly a 4% CAGR. There was no growth. But what do we look out for? Companies that are growing faster than the index, and that's where we are typically placed. I'll give you an example. I'm just going to run this through. Avanti Feeds, it was a market leader in feed business. The EPS grew at 68% CAGR. The stock price grew at 70% CAGR. It was a market leader. High Union bought stake in this company in 2010. So it is 45% of feed business. The prawns ka jo khana hota hai for India. So the customers love the product. This guy is again a monopoly, did fairly well. Astral Poly, they had a tie-up with Lubrizol. Lubrizol is 80% global market share in CPVC business, and they scaled up the CPVC. There was a value migration happening from steel pipes to CPVC pipes. So Astral was the market leader until 2013 when Finolex came in. They had no competition. The price CAGR was 48%, earnings CAGR was 23%. Bajaj Finance, monopoly in consumer lending business. Relaxo, monopolies in shoes. Eicher Motor, monopoly in the premium bike segment. Page Industry grew its EPS at 25% CAGR. So what I'm trying to say is that what we have to look out for and ask ourselves just one question: what are the 15, 20, 30 companies that we believe can sustainably grow for the next 10 years at 15, 20, 25% CAGR? I have no idea what Nifty EPS will be in 2030. My role is to be in the higher quality growth stocks in the country and make a portfolio of 15 odd growth stocks. Sankal, we'll move to the next slide so that we can finish more things. Trends, this is the most important part, and this is where we specialize in. Hear to this carefully the next 3-4 minutes. We will try to wrap it up very fast after this slide. Amazon got listed. This is my 8th principle trend. Amazon got listed at $2 in 1997. The stock price went up 60x and it was trading at $110. The revenue of Amazon went in Q1 1997 was 16 million. From 16 million, it went to 650 million. And that's why the stock went up from $2 to $110. Market chases growth always. 1996 to 2000, the profit of Infosys went up from 13 crores to 286 crores, growing at 150%. And the stock price of Infosys went up 300 times. Wipro went up 500 times. There was a massive IPO fancy in between 1996 to 2000, and that was the technology bubble. Sankar, we move to the next slide. We do it quickly now.
Sure.
This is This is the pharma trend. Remember, for those who are new in the market, between 2009 and 2014-15, Nifty EPS growth was only 6%. It was a very bad period, but that time consumer and pharma were just nailing it off the park. Why did that happen? If you see, between 2008 and 2014, Sun Pharma's profit went from 1,500 crores to 5,000 crores. Aurobindo's profit went from 61 crores to 1,500 crores. These companies were growing at 30, 40, 50%. Lupin's profit went from 322 crores in 2008 to 1,800 crores. This was the time when there was no growth at all, and market was chasing growth. But why did this happen? Sankar, we move to the next slide. This happened. Why did this happen? Because Indian companies are generic companies. They export at a cheaper price to US, and a large number of drugs were going off patent. As soon as a drug goes off patent, let's say it's a $10 drug, the price drops by 90%. And when the price drops 90%, they cannot manufacture in California and all those places. They start manufacturing in cheaper countries like India. You can see between 2010 to 2015, the number of drugs that were going off patent was massive. And that's how you started the pharma cycle in India, and massive wealth creation happened. And then they fizzled out in 2015 when the patents, the new patents were not come. Sankal, we move to the next slide. Now, this is the NBFC crisis bubble. Massive wealth creation happened. And of course, a lot of money was lost as well. between 2013 and 2018. For people who remember, 2014 Raghuram Rajan said that all banks will have to start declaring NPAs. When banks started declaring NPAs, like 10, 15% NPA, these banks could not lend anymore. NBFCs came and started lending. If you see the profits of Bajaj Finance in 2013 was 561 crores. It went to 2,700 crores, a 5x gain. And this was the time when Nifty earnings was 1% CAGR, and these companies were growing at 40%. Edelweiss grew profits from 178 crores in 2013 to 890 crores, a gain of 4x, 5x jump in profit. Nifty was growing at 1%. Market chase growth, and these stocks went up 10, 15, 20x. Like Canfin Homes, the profit in 2013 was just 54 crores, and it went to in 2018 it made a profit of 302 crores, a 6x jump in profit. And that's where large trends and bubbles were made between 2013 and 2000. We need to find these high growth companies to get the right trends. The next mega trend, common things I expect, 20-30% growth at least. Most trends are global in nature. The 1996 to 2000 was not just an Indian trend. Amazon, Yahoo, all these companies rallied as well. Most trends are global. 2003 to 2007 was not just an Indian real estate trend. It was a global real estate trend. And that's how the subprime crisis happened in USA. So trends are global, they're typically never local. The current trend is clearly towards technology, gold. These are large trends. So a trend starts with a large change in an industry. They're typically the first ones to break out. But remember, every bull market has a different leader. So except HDFC Bank and a few stocks, there is no data which suggests that the leaders of the previous bull market did well in the next bull market. So we typically avoid the leaders of the previous bull market. All you want is trending prices and trending earnings. As long as you have these both, you will have a trending network. Remember one thing: the leaders of the bull market do not go up 1x or 2x. They typically go up 10, 15, 20x. All you need is one large trend to make it large in the market. Next slide. This management traveling from city A. Okay, I'll just tell you the small story. I'm so sorry we have to rush this through. Basically, we're very smart, but this management is all I'm trying to say. We run first, ask a lot of questions later. If we find risk, we're the first ones to get out. There are 4 kinds of risk: business risk, management risk, valuation risk, industry risk. We have to take one of them most of the time. Remember one thing: trends typically don't correct more than 20% and stay there. They typically correct and then they bounce back again if they're a trend. Yes, we will rush this through so that we can take questions. I'm so sorry. Sangal, we go to the next slide.
Sure.
Just one thing I want to tell you guys. Stallion, given a choice for us, managing risk is very important. I've been a trader before being a portfolio manager. Given a choice of high risk, high return and low risk, decent return, believe me, we will always choose low risk, decent returns. We don't want to be the rock stars of the market. We're okay with sustainably compounding capital at 18 to 25%. There are only 4 things that can happen when you take a position: big profit, big loss, small profit, small loss. 4 things: big profit, big loss, small profit, small loss. If you can avoid the big loss part, you will be left with 3 things: big profit, small loss. We try to avoid big losses. There is no bigger mistake in investing than holding on to your losers for a long time. Being wrong for us is acceptable. Saying wrong is not. It's stupidity. So yes, that's the 10th principle. We'll move faster now. Sankalp.
Sure.
India versus India was a $1 trillion economy in 2008. Today, we are about a $3 trillion economy. So a lot of thing is there that small caps, small caps, but think about it. Our GDP went from 1 trillion to 3 trillion. How many small caps actually became mid cap or large cap? I can tell you, you can just name a few ones. Avanti Feeds, Relaxo, Page Industries. What was common in all these companies? They were all market leaders. They were debt free. When you're buying small caps, make sure you buy a leader. I showed you. We want to buy leader in niches. 200 crore ke dhande mein 100 crore ka pie. You don't want to buy 10,000 crore ke industry mein 100 crore. Wahan paisa nahi banne wala hai. So small caps, we look at technology, fast, like you want technology right now. That's where the next decade of large earnings growth will come from companies that are technology to solve large customer problems, and they can create monopoly. See, if you I need to rush, or else I would have gone. I can discuss about this slide half an hour. But if you think about it, the only time people make money in small caps, the only years people make money is 2017, 2013, 2010, 2007, 2003, 1999, 2000, 1996, 1990. ये हर 4 साल में एक बार रैली करते हैं फिर सो जाते हैं. Small caps, making money is easy. Retaining it is very difficult. Very difficult. So you can trade small caps, but you should not have a large portion of your wealth. But you can trade these 4-year cycles. That's where large money can be made in small caps. Yes, next. People we look out for, we're just 5 minutes now, 3 minutes, I think, maximum. If you see the last 30 years in India, a lot of people say a lot of not so good things about India. Let me tell you, if you see the last 30 years of India, the largest wealth creators has been a portfolio of MNCs. A portfolio of MNCs have beaten the Nifty every 3, 4, 5 years. You just buy a portfolio of 10, 15 MNCs and you will beat the Nifty so easily. It just tells you what good ethics, a decent product, and large opportunity size can achieve. What are the kind of management and people I look out for? This is the mindset that I want my management and my companies to have. Number one, every customer is loyal to you till the second they find a better alternative. Rule number one, be customer focused. Market caps are not created on the Lal Street, they're created on Real Street. It is always worth the pain and cost to be a market leader. Rule number two, my management has to understand that competition sucks and there is nothing worse in this world than competition. Every great business starts, this is the third rule, every great business starts with solving a problem, and then you have to keep addressing a larger opportunity size. Amazon started with books, it went into everything else. Same with Flipkart. So you start, like Zomato started like a review company, now it's into delivery, Zomato Gold. So you start with a small niche and then keep going into larger market sizes. Capital allocation, 90% of businesses in India fail because they do not understand leverage. Growth is great, but not debt-led. We do not like companies that grow by taking a lot of debt. Rule number 5, vision. When Henry Ford made cheap and reliable cars, people said, nah, what's wrong with the horse? That was a huge bet he made. You need management that are thinking big. Kab tak Maggie loge? Kab tak these 10% growth? You need some great businesses and businesses that are creating monopolies in your portfolio. Next one. So concentration versus diversification. I'll tell you one thing. I've been in markets long enough, and I know one thing for sure. There will always be someone who will be getting richer faster than us. Greed is good, but envy kills. We do not have a less than 7 stock portfolio will psychologically damage your emotion. Like it's very painful psychologically. If you have a more than 30 stock portfolio, your returns are very close to the benchmark. We at Stallion believe a 15-20 stock portfolio is ideal combination with allocation depending on set rules like market leadership, ROIC, growth, free cash flow, competitive advantage, and interest rate. Our focus is not to just get rich, it's to stay rich. Concentrated portfolios make one mistake after 7-8 good years, and your performance can change. Remember a very, very, very important part of Stallion. Given the choice of getting of high risk, high return, and low risk, decent returns, we at Stallion will always, 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 always choose low risk, decent returns. Our portfolio, this is the last slide. A portfolio, the Stallion way. Our portfolio is a combination of consumer, financials, technology, and pharma. Typically consumer. So the way our portfolio is divided is consumer and our pharma companies are low on beta. Even if you see this fall, my consumer portfolio and pharma portfolio is positive and it's doing well. Whereas my financials and technology is high on beta. So in a bull market, my financials and technology just nail it and they hit it out of the park for me. Whereas in a bear market, my portfolio gets protected by consumer and pharma. So our portfolio is low on beta. Our portfolio beta at the peak of the cycle was 0.65. Today, my portfolio beta is 0.28. So we keep so now that we are not so bullish on the market, we are low on the economy, we keep our portfolio beta low. So today our beta is 0.28. So the market falls 20%. Theoretically, our portfolio should fall 5.6%. On portfolio level, we want to grow at 20%. Our consumers and consumer pharma basket grow at 15%. Our financials and technology grow at 25-30%. So on portfolio level, we grow at 20%. A big ass opportunity, decent predictable growth, smart promoters, happy customers, low competition, actually no competition, getting better with price, size, great capital allocation, and basically where we believe future value is higher than today's price. A portfolio of 15 odd stocks, 60-70% in quality companies with 30%, 40% weight in trends. Yes, so that's the last slide. Sankalp, we can move to the last slide. So these were my 14 principles, and this is my 15th principle. Change is constant. There are no perfect principles. We change, learn, evolve every year. In 2016, I swear to God, I used to think I'm really smart. But when 2017 came, I realized एक साल पहले तो क्या गधा था, अब मैं बहुत होशियार हो गया हूँ. And now I know a lot more about markets. In 2018, the same thing happened. I thought that like 2017, I thought now I'm very smart. And then when 2018 came, you realize that yeah, 1 year back I was so stupid, and now I'm so much more smarter. So basically, change is constant. I hope I look stupid 1 year from today, because today I think I'm smart and I know the market. But I'm sure 1 year from today, I would come to you and say, यार एक साल पहले मुझे मालूम नहीं था, आज मुझे सब कुछ मालूम है. And this is evolution. And if this doesn't happen, that means I didn't learn anything new. So these are my principles. We keep changing. We keep learning. Thank you so much, everyone. Thank you. We take the questions, Sankalp. Thank you for listening. Sure. I spoke for an hour. I'm so sorry.
So no problem. So Amit, while you catch a breath, I will narrate a few questions and maybe you can answer them. So as a matter of benefit to the participants, we will take questions now on the portfolio. You spoke a lot about how you select stocks, how you look at the market and the market view. So the first question that I think is very interesting. So, Amit, I noticed you are a CFA and a CMT charter holder. You don't like value stocks. Typically, growth stocks, you say you sell out of positions also quite quickly before, you can tell others. So what is the philosophy that Stallion follows? We went through your interesting process of selecting stocks. So what is the process, or what is the philosophy at Stallion? Is it growth? Is it trend, or what kind of philosophy is it?
We want great, secular, high quality companies growing fast. So if a commodity company is growing, let's say chemicals, to the best of my knowledge, Stallion in all our products, we have no position in chemicals at all. So yeah, you cannot think about it. These companies are not monopolies. Let's take an example of art industry. वो benzoin बनाता है भाई, वो commodity है. but how do I pay 45p for a commodity company? I can't do that. So we want consumer monopolies, which are growing at a very decent pace. We do not buy bad quality businesses, even if they are growing fast. So we typically want to be in good quality businesses that are growing. It's not that our churn is high. Our churn last year on the PMS was 11%. So that's a very less churn, I would say. It's lesser. Like the average mutual fund churn is 40-50%. This year, we've exited some leverage companies. So our churn is about 25-30%. To the best of my knowledge, I'm just saying it from memory. Just don't take this on record. This year, our churn on the portfolio on the PMS would be 25%. So it's not our portfolio is not high churn. Our portfolio long-term churn would be 20-25%. But these trends are for 5 years.
Okay, so long-term growth trends. If I can summarize, you like long-term consumer growth trends over cyclical ones, if I am getting you right.
So there are 4 kinds of businesses, Sankar. There is business to consumer, B2C, then there is B2B, so business to business, government to business, so and business to government. Business to government is like Dilip Bilkon, an infrastructure kind of player. Our portfolio is 90% always in B2C companies. So we do not do, unless there is a monopoly or technological edge for B2B companies, we typically focus on B2C companies only.
Okay,
they have free cash flow.
Thank you. Thank you. So the next question is actually pretty interesting. So trends are often, there is always a trend in the market. So how do you know which trend is a more long-term trend and a more structural trend? And at what point in the life cycle of the trend will it come to the Stallion portfolio?
Yeah, you look at growth rate.
You can use examples here, Amit. I think.
Yeah, I'm scared. I was just thinking about that, but I'm very scared. This is the first time I've stopped media as well for the same reason, because I end up speaking stocks and then it's not good.
Sure.
But like we look at growth rate. So think about it. Today, Nifty EPS is 450. Okay. If you take the best case scenario for Nifty EPS for FY22, this is Morgan Stanley, who's like the most bullish guy on the street. His EPS estimate for Nifty is 480 for FY22. If you look at Goldman Sachs or all those guys, it's between 440, 430, 470, 450, वैसा है. In the best case, Nifty FY22 estimate is a 6% growth from where we stand today. You need to look at companies that will grow more than 6%. Like let's say Muthoot Finance. Okay, I'm just taking examples. Please note, we can do anything to our portfolio. Muthoot Finance grew at 100%. Unsecured lending is now over. Okay, there will be no unsecured lending for next 1 year. Gold prices should move higher. So the tailwinds are there. In this kind of company, if you get 25% growth, the markets will not keep it at 10p or 2.5 times price to book, because the ROE is 30%. Why should this one trade at 10p and he pays out a lot of money as dividend, 3%, 2.5% dividend yield? Ye hoega nahi. So you will see wherever you find pockets of growth, you be there. How do we know trends are reversing? We don't know. Basically, trends do not correct more than 20-25% and stay there. It's not that they don't correct. They don't stay there typically more than 3 months. There is no data of trends of last 100 years in the US market where a company corrects 25% plus in a trend and stays there more than 3-4 months.
Sure. So that's very insightful.
But I'm just telling you a disclosure. We might have positions. We might do anything, but I'm just giving you a disclosure. Yes.
Yes, that's a statutory disclosure. Thank you, Amit. That makes our job easier. So the next question is actually again, there is very little we can do to make our portfolios COVID proof or natural calamity proof. So does Stallion, Asset believe or is a proponent of portfolio hedging for long-term investors using derivatives? What do you think on that?
It's not a bad idea. In one line, I would say, you need to have principles. It has to be computerized. Let's take an example. If VIX goes above 20, you can hedge your portfolio for 3 months. Typically, what will happen is, so these are just hedging techniques that I don't think this is the right platform.
Sure.
We've not done hedging. I believe we missed out on
it. But you think it's not a bad idea? Thank you. So we will for the ease of regulations, we will stop at that. So the next question that comes is, if you can maybe tell us sectors or trends that you think will benefit once we open up, or sector or trends that had competitive advantage will cease to have them. Just a broad thought so that it helps people understand the portfolio.
See, I'll tell you, I'm very confident on technology. I am super confident on technology for next 3, 4, 5 years. I'm not thinking about Infosys and TCS. My top bets are, like today, I'm very bullish on technology, number 1, in my basket. Number 2, consumer. Number 3, pharma. Number 4, financial. So in our ranking, we are very confident on our technology. Technology just started a trend. Financials were the leader of the previous bull market. The weight of banks on Nifty between 2009 and 2019 went from 11% to 33, 34%. So basically, if you know you were not there in financials, you never made money. I can tell you for last 7, 8 years, we have a public portfolio as well. We've been 50% financial. So, but now we are at the lowest financial. On our PMS, our financial weight would be what, 10%, 15%. So we are at the lowest financial level. So I am very strong confidence that 3 years, 2 years from today, we will have Hotstar getting listed. There are so many profitable businesses. I can see the next decade through. You will make unbelievable money. See, I'll tell you, there is always a trend. In India, there are about 30, 35 stocks that are always in a trend. In that trend, about 10, 15 stocks keep changing every 3 years. So in this cycle, if I think probably financials have changed, like 15, like I'll give you an example. 2009 to 14, everyone was in pharma and consumer. We were also in pharma and consumer. In 2014, the trend changed. 15, the trend changed from pharma, because that was the first time that US FDA problem started. And the trend changed from pharma to financials. So consumer trend remained, and you had your financials getting added. Few financials got out in 2018 after the NBFC crisis. So yeah, and then quality came in, and quality stocks started doing well. So there is always, India is a 30 stock market, and I have no idea why people keep complaining that market narrow hai. There is no data except 2017, 2014, 2009, 2010, 2007. Markets are always broad. Even Jesse Livermore in his book writes it in 1940, that markets are always narrow. Only sometimes markets are broad. So you have to be in that 30, 35 stocks, Indian markets, and those will be the stocks that will be growing. And don't worry that what will happen for Nifty economy, ये सबसे ज़्यादा कुछ फर्क नहीं पड़ता है. In 1918, there was Spanish flu. No one that time could even think about it in the US market that you will have, and 1919, the First World War ended. No one thought the best bull market in history of global markets will come between 1919 and 1929. That was the largest. Just Google about the 1920s bull market, and that is when the global depression happened. In 1929, the depression, the largest Great Depression happened. उसके पहले बहुत बड़ा boom था. Who would have been able to predict the market? We do not like to predict the market. We have some cash in the portfolio just because we are not getting growth opportunities. If we get growth opportunities, we don't time the market. You cannot time the market. You have to be there in the game. If you be there in the game 10 years, believe me, and you're smart enough, believe me, nothing stops you to make very decent compounding for the next 10 years. But you have to survive every cycle. Bull, bear, दुनिया यहाँ से वहाँ हो जाए, गेम के अंदर ही रहना.
Sure. So we will take last couple of questions. The first question that the penultimate question is, financials are a more broader space. So far the rally has been led by lenders. Typically, if I talk about financial guys, so there is a whole array of financials that I've listed in the last couple of years, like the insurance businesses, the asset management businesses, stockbrokers. So do you think there's a rotation that is in the cards from lending part of the financials to the other financials that have listed recently?
Yeah, yes. Like we are also positive on insurance. We like the general insurance basket a lot more. industry, you need to back the leader here, and the leader is managing risk very well. If you think about it, I'm just giving an example. This is not a recommendation. Like ICICI Lombard, he doesn't do crop insurance. Where he stopped crop insurance because that business doesn't make money. That's what good managements do. This company, 50% of the market is by your public sector guys, and these guys are most inefficient guys. इनको best competition world की PSUs है, and these are very inefficient guys. लोग fire insurance करते हैं. Look at the combined ratio. 100 रुपए का insurance लिखते हैं और 130 रुपए का loss करते हैं. So they are like the worst players. ICICI Lombard should grow at 10, 15, 20, 25% for next 10, 15 years, I think, in the general insurance space. And that space is a lot better than the life insurance space. Even if you see Benjamin Graham, his portfolio from 1926, when he started, Benjamin Graham is the father of value investing. Till 1950, वो 25 साल के लिए उसने जो सबसे ज्यादा पैसा कमाया वो एक ही स्टॉक में कमाया है, गाइको. That was the general insurance company. The business gets better with size. You cannot beat a general insurance player and it's a float business. It's a free cash flow business, best business. General insurance, I believe, should create very, very decent wealth in the next 5-10 years in India. We are very under-penetrated. Our total general insurance in India is just $20 billion. I see this industry becoming, so from the $20 billion, the largest player is $2 billion. The industry will become 100 billion. The largest player can be 10 billion, 15 billion, 20 billion, I don't know. So we just have to bet on good management, but it's a great business model. It uses technology to solve large customer problems. ये सिर्फ technology का काम है सर. कौन सा insurance कोई product थोड़ी ना है. Scalability है बहुत.
So alternative finance has some way to still enter our markets. Good. So we will come to the last question now, Amit. So last time I met you, we were discussing about your advisory model, advisory business. So you are a new PMS. So what advantages to the investors does a PMS offer is what I would like you to conclude with, because we have participants asking about your PMS. So typically, what are the advantages a PMS offers to the investors and to you while you are managing their money is what we would like to hear from a fund manager himself.
So I'm the founder of Stallion Assets. Stallion Assets got two different divisions. One's the research division, as you rightly said, and one's the PMS division. Both should do well. These are my babies. Ankush is the principal officer for research business. Both portfolios should do well. I have no doubt. In the PMS, we execute. So we are one of the larger advisories in the country. We can only have like top 100 stocks maximum that we can do in the advisory platform. There is execution cost on the advisory. Let me tell you, advisory is a fantastic platform. But with size, there are only some stocks that we can buy. So we are focused more on the large cap. And on the PMS, we do large, mid, small, everything. So example, we're buying a company now. So if there are 10 days, 15 days, I need to buy a company, a technology company. I can't do it on the advisory front, because if we buy something, it's basically out there, and there are like thousands of people buying that stock. So our advisory is a little restrictive. That way, it's a great platform. It still beats, our advisory also beats 90% PMSs. So our PMS does a little better, but both are good products. And PMS is basically, you don't have to execute, you don't have to do anything. The portfolios are 50% same. Some quality stocks are the same. The trends are going to be different in both portfolios. We don't know which one will perform better, of course, but both are fantastic products. They are my babies, and we love them both. So,
sure. So thank you, Amit, for being on the call today. Thank you to all the participants. You can know more about the Stallion asset portfolio at www.pmsaifworld.com. We hope to hear from you. Thank you, Amit. We hope to host you soon again. Thank you, participants.
Thank you. Thank you so much. Thank you.